today's speaker, which is Mary Ann Collins, and then get started from there. So hope you are all doing well today. First, I want to take a minute to recognize the associations that we have on today, which includes Rhode Island MBA, MBA of Eastern Pennsylvania, Ohio MBA, Indiana MBA, and it kind of sounds like we're going east to west at this point. So we'll bounce south to the Kentucky MBA, back east to Massachusetts MBA, New York MBA, MBAC, or in other words, Mortgage Bankers of the Carolinas, MBA of Florida, and the Illinois MBA as well. As you know, associations deliver a lot of value locally, both in collaboration, advocacy, and then also education. So if you're active in your association, great work. If you're not active or you're considering associations, this is really a good time. You know that there's a lot of things that are happening in our industry, both at a federal level and a state level. And it's always engaging and rewarding to be involved in getting to the table and explaining to some of our politicians, not only the perspectives of industry, but also help sometimes prevent unintended consequences. So there's a lot of different ways to get engaged. The first step is to reach out to your president or executive director or one of your board members, and just let them know that you want to get involved. You can sit on a committee. You can utilize your leadership skills in the association to help it grow and prosper. There's really a lot of options, but especially with the changes that we've had in our political environment today, it's an especially important time for those associations to be active and involved. So I'll go ahead and turn it over to Casey to get us rolling. Quick intro, and then on to the program with Mary Ann.
Thank you, Scott. Good afternoon, everyone. I am Casey. It's my pleasure to welcome you today and introduce you to Mary Ann Collins. She is our president of Government Lending Training Division here at Deal Mortgage Training and Compliance. She also is the former executive director and the chief operating officer for both the Ohio and New York Mortgage Bankers Associations. Prior to Deal and the trade associations we just mentioned, Mary Ann spent 35 years in the mortgage banking industry, with her most recent position being Senior Vice President of Mortgage Lending for a Central Ohio bank. Mary Ann is also a former member of the Fannie Mae National Advisory Council. She's past president of both the Columbus and Ohio Mortgage Bankers Associations and a former member of the National MBA's Board of Directors and Board of Governors. Mary Ann is a winner of the MBA's Burton C. Legislative Award, a two-time winner of MBA's Schumacher Bulldog Award, and was the first recipient of the MBA State Leadership Award, which was renamed in her honor in 2019. In the 2013 Centennial edition of Mortgage Banking Magazine, they named her one of the 20 leading industry women. So from all of us here at Deal, we wish you the best of success and with this informative update and any of your future endeavors.
Thank you, Casey, and thank you, Scott. What we're going to do today is just talk about, first of all, some recent underwriting guideline changes in FHA, VA, and USDA, but we're also going to talk about, when it comes to USDA, some things that USDA has received in the way of questions that you won't find answers for in the handbook. So a lot of these are little known items that would be of interest to you. Now, I will tell you, if you are a member of the Ohio or the Indiana Mortgage Bankers Association, the content of today's course is the webinar that I did for your convention. So there will be a repeat of that information. What has been added since doing those presentations is recent guidance that FHA came out with on student loans. So this is a pretty quick presentation. We'll be together probably less than 30 minutes. But I'll try and pack all this information in that time. You've already heard about me. Just want to take a minute to talk about Deal. Deal's been around since 1983. We do training on FHA, VA, and USDA underwriting, processing, and origination. We can do it through the trade associations. We can do it strictly for your company if you would like to contract us for that. We also do Safe Act pre-licensing and continuing post-licensing, continuing education, and we do many compliance courses. Our courses can be either by webinar, online, or in person. So let's go ahead and get started and let's talk about some recent changes with FHA. Just got a new mortgagee letter. And in that mortgagee letter, we have new guidance on student loans. And we have been asking FHA this for quite a while because we felt that their required payment was high. And so the MBA has and lenders have really been after FHA to come out with some new guidance and get more in line with agencies like USDA. This new guidance that we got is probably the most liberal guidance that you'll see when it comes to student loans. So under the previous guideline, the payment calculation was the greater of 1% of the outstanding balance on the loan or the monthly payment reported on the credit report, or if the payment was, the actual payment was less than the greater of those two numbers, the actual payment could be used if the loan was a fixed rate, fixed payment, fully amortizing loan, and that had to be verified by the servicer, but could be verified through their website. The new guideline, which goes into effect in August, however, you can start using it right now, is that the payment amount, the payment calculation will be the payment amount reported on the credit report or the actual documented payment when the payment amount is above zero, or 0.5% of the outstanding balance when the monthly payment reported on the borrower's credit report is zero. So, that's saying that you can use those income-based, interest-only, balloon, all of those types of student loans as long as you stick with this calculation. So this is really, really great news. When it comes to manufactured homes, we have some guidance that will expire at the end of the year, but it's currently in effect, and that is first of all, under the previous guideline, the appraiser must include at least 2 manufactured homes in the comparable sales grid if your subject property is a manufactured home. Under the new guidelines for manufactured homes certified based on the construction requirements of Fannie Mae's Manufactured Home Advantage or Freddie Mac's Choice Home Program, the appraiser must include at least 2 comparable sales with that similar certification when available. And if less than 2 are available, the appraiser must use other factory-built or site-built construction and provide a detailed justification for doing that. There was a revision in the condominium project questionnaires that had 9991 and 9992, depending on whether you have a single unit approval or you are doing a project approval. Under the previous guidelines, the form was to be completed, signed, and dated. No instructions were provided by HUD on how to complete the form, and condominium associations were required to complete the forms and sign the certification. With the new guidelines, data collection on the questionnaire is to be no more than 90 days old prior to the signature. Instructions were developed to explain how questions should be answered. The association would only certify and sign the 9992 if they were actually the submitter. There were many revisions in data requirements on both forms. Now that's really all that's happened with VA or FHA. So let's talk about VA. The big thing as far as recent developments with VA is Circular 26-21-08, which is the eligibility requirements for National Guards. Previously, the requirement was that a member of the National Guard was eligible after 6 years of service, unless they were called to active duty. If they were called to active duty, then 90 days in wartime, 180 days in peacetime. The new requirement under the new circular is that members of the National Guard, and remember, we are only talking about National Guard here, not reservists. Nothing has changed for reservists, but for National Guard, if you have someone that has been in the National Guard for 90 cumulative days of full-time National Guard duty, in which 30 of those days were consecutive, they will qualify for VA benefits. So that is just huge for members of the National Guard. There's also been some enhancements to the certificate of eligibility. Under a previous procedure, lenders were permitted to submit the form 26-89-37, which was the verification of VA benefits, and you would fax that, to your regional loan center to get that completed. Under the new procedure, which you can read about in Circular 26-2103, if the information the lender is seeking to verify is already on the COE, VA is not going to process the form. The form should only be submitted when additional information is needed. And that would be cases such as if an active duty service member has received a disability proposed or memorandum rating, or a pre-discharge disability claim is pending. If a COE states to submit the form, or if system limitations cause anomalies on the COE that are not resolved after calling VA at the number that we have listed here. The form should be submitted only through WebLGY by selecting a new application under electronic application. Faxing is no longer permitted. Now let's get to USDA. Let's talk about things that you probably may know about some of, and many of them you may not know about because they can't be found in the handbook. So let's talk about the new form 355521. And that under the previous form, the income calculation worksheets were part of the form. And this is your request for a single family housing loan guarantee. Under the new form, the worksheets are no longer part of the form. Annual and repayment income calculations, though, must still be documented for all loans. If you get a GUS accept, then you as the lender will retain the calculations in your file. However, any other type of approval, such as an accept with full documentation, refer with caution that are manually underwritten, or any manual underwrite, a copy of those calculations is to be submitted to USDA using, sorry, should be submitted using Form 9B along with the complete loan application. In regards to appraisal and property requirements for USDA, a second appraisal may be ordered if a lender determines the initial appraisal is unacceptable. The cost of the second appraisal cannot be financed, even though the appraised value allows the financing of closing costs. The market conditions addendum is no longer required for USDA loans, and appraisals can only be transferred between lenders for the same applicant, but cannot be transferred between applicants. New construction, it is the lender's responsibility to determine who is a qualified inspector when the local jurisdiction does not perform construction inspections. In regards to property inspections, if the appraiser indicates repairs to be completed and that original appraiser is unavailable, maybe they might be on vacation or something like that, another appraiser can perform the final inspection if they are able to certify the improvements were completed in accordance with the requirements and conditions in the original appraisal report, if they provide photographs of the completed improvements, and they sign the final inspection report. Water quality tests are required for individual water systems in a purchase transaction. They are not required in a refinance transaction. The lender, though, may require the inspection at their discretion. There is no requirement for more than one contractor bid for determining repair escrows. So that really completes information on property inspections. Now let's talk about the closing. Rural development does not permit additional rural development does not prohibit additional parties from being on title. Additional parties can be on the title. They have no problem with that. Rural development does not dictate if or when deed restrictions are acceptable. It is the lender's responsibility to ensure they obtain marketable title with a first lien position and have the ability to foreclose and or conduct loss claim servicing. If a loan closed at a higher loan amount than what was authorized on the conditional commitment, a principal reduction is not allowed. The lender may perform a loan modification to correct the loan amount to match the issued conditional commitment, or request that rural development release the GUS loan back for the lender to make the corrections. Also with closings, if a loan closes at a higher interest rate than what was authorized on the conditional commitment, the lender may perform a loan modification to correct the interest rate to match the conditional commitment, or if that is not an option, the lender must request a release of the GUS loan back for correction. Once the interest rate has been corrected and a new underwriting submission may be performed, Rural Development will review the updated submission and, if approved, issue a new conditional commitment. So hopefully that will happen because your loan is already closed. An applicant cannot receive cash back as a result of a tax credit from the seller for taxes paid in arrears. The credit may be used, though, to pay closing costs, but cannot result in cash back to the applicant. Only costs initially paid by the applicant out of pocket can be returned to the applicant at closing. When there are excess funds from the seller to pay the buyer's cost to close that are not being used, it is acceptable to use the extra seller paid cost as a principal reduction. The funds cannot be dispersed as cash to the applicant. A principal reduction at closing is acceptable if the borrower is getting more cash back than they put into the transaction. There is no limit on the amount of a principal reduction. However, the lender should determine if a loan modification would be a better option. A borrower may not take title in the name of a trust. USDA is really different than other agencies in that they don't allow that as FHA does, for instance. An applicant cannot finance any borrower paid real estate commission. Normal and customary costs may be included in the loan up to the appraised value. But if it is customary that the real estate agent's commission is paid by the seller, which it is everywhere in the country that I know of, it would not constitute an eligible loan cost. An applicant may use personal funds to pay the commission, but they may not finance it. Secondary financing. USDA does not have a maximum CLTV. However, the total value of all liens on the property must be less than or equal to the property's appraised value, except when a soft second for down payment and or closing cost assistance creates the overage. As far as applicant eligibility, funds from down payment assistance do not need to be included in the conventional credit test. We all know that for USDA, that it is for the borrower that does not qualify under for conventional financing under the conventional credit test. In other words, they must have the funds for 20% down and the closing costs. They must be within certain ratios, those kinds of things. So you do not need to use the funds for down payment assistance in that 20% calculation. Also, funds from a self-employed borrower's business account are not included in the conventional credit test. When an applicant is permitted to retain their current residence due to relocating for a new job opportunity, there is no minimum distance requirement. However, you should be using common sense when it comes to that. If an applicant's non-borrowing spouse owns a home in their name only, the applicant may get a USDA loan. The requirements in Chapter 8 of the handbook for retaining a dwelling apply only to the loan applicants, not to household members. If a current dwelling is secured by USDA loan to spouses and one of the spouses is awarded the home in a divorce, the other spouse may not get another USDA loan until the home is refinanced to a non-USDA loan. In regards to assets, if a real estate agent is representing themselves in a USDA purchase, the sales commission cannot be used as reserves. Regarding bank account requirements, when USDA says most recent, that means at time of submission to USDA, not at time of application. With credit history, an account that was previously in dispute but is now resolved would no longer be considered a disputed account. Although NSF fees on a bank statement do not affect an applicant's credit score, it remains the applicant's responsibility to review the credit history to determine an ability and willingness to pay the obligations. Delinquent state taxes should be treated as unpaid debts or collections. Evaluate if the debt, though, poses a threat to the first mortgage lien and is it likely to have an adverse impact on the equity or the applicant's repayment ability. With employment and income, all adult household members must have a Social Security number, ITIN number, or other identification to confirm that they are legal U.S. residents. Tax transcripts are required to be obtained on all adult household members. If the required documentation cannot be obtained, the lender will be unable to submit a complete loan application. There is no threshold or length of job gap time guidelines. Lenders are responsible for analyzing any gaps in employment to determine if the employment is stable and the income is dependable. If Social Security income is paid solely to a non-borrowing spouse on behalf of a minor, it cannot be used in repayment income, even if it is deposited into a checking account that is joint with the borrower. When an applicant recently started a new job, they have to receive a pay stub before the loan can be submitted. Shift pay can be included in repayment income with a 12-month history. And even though an applicant may work mandatory overtime, a 12-month history is required to include it in the repayment income. Gift funds may be used to pay off debt. When a relative is serving as a buyer's real estate agent and would like to gift the commission to the buyer, it would not be allowed because gifts cannot come from interested parties. However, the commission could be provided as an interested party contribution if the total of all seller and other interested party contributions do not exceed 6% of the sales price and represent an eligible loan purpose. A gift of equity from a family member is to be used to reduce the sales price, not as down payment. With liabilities, when a borrower is being relocated by their employer and the employer or relocation company takes over responsibility for the current home, if the title and loan remain in the borrower's name, the debt must be included in the debt to income ratios. When a borrower self-reports utility bills on a credit report, the debts are not required to be included in the debt to income. And that completes our presentation. I hope that these updates informed you about some things that you weren't informed about. Remember, deal in any of your future training. And we will get a copy of this presentation out to all of you that have registered in the next day or two. So thank you, everyone, and have a great rest of your day.